Hi dear traders, markets closed last trading week at the levels where they opened it. As trading was rather volatile, both buyers and sellers could gain profit this time. Let's analyze the events that were affecting the quotes in the commodities and forex markets. Last week, the US dollar got support from a rise in the US Treasury yields. Hawkish comments made by some Fed officials brought back speculations about the Fed continuing its aggressive monetary tightening. The US dollar index, which demonstrates its value against the basket of 6 major currencies, returned to the level of 107, staying close to the 3-month low. The greenback managed to win back some of the losses it incurred after the CPI data showed that inflation in the US has slowed down. Now traders will be evaluating inflation reports for November and December. This allows the market to predict the possible changes in the Fed's monetary policy. Meanwhile, the inflation data in the Eurozone is quite straightforward and shows that consumer prices are rising, beating one record after another. In October, inflation hit 10.6%, while the target level is 2%. Given the current situation, the European Central Bank will continue to raise rates at a fast pace, even despite the threat of recession. Besides, the regulator is planning to cut their quantitative easing program. All these factors allowed the euro-dollar pair to stay above the level of 1.03. The British pound showed a notable recovery last week as traders were encouraged by the upbeat economic data. On Friday, the report on retail sales for October revealed that sales unexpectedly rose last month. UK Chancellor of the Exchequer Jeremy Hunt outlined in his autumn statement a £55 billion package of tax rises and spending cuts, adding that the UK economy has already entered a recession. Yet the Bank of England is likely to stick to its plan and continue to hike the rate in an attempt to curb inflation. This is a big supporting factor for the pound. In the meantime, the Bank of Japan insists on an ultra-loose monetary policy. The Japanese authorities aim to prevent the economic slowdown in their country in all possible ways, even amid high inflation. At the same time, the Japanese yen is suffering strong pressure due to such a policy, as it differs greatly from the monetary policies of other major central banks. Previously, the yen used to strengthen amid market uncertainty and geopolitical risks. Another trading instrument, gold, has lost its shine among investors as a safe haven asset. When central banks hike interest rates, investors prefer to move their funds to government bonds. Another hint that the Fed may keep its aggressive tightening in place changed the appeal of the US Treasuries. As a result, gold dropped below the key level of $1,760 per troy ounce. Oil became the main outsider of the week, plunging by 9.5%. The trading instrument came under pressure due to the negative outlook for crude demand. A new coronavirus outbreak in China, which is known to have zero tolerance towards the virus, increased fears of renewed quarantine measures. If so, energy consumption in one of the world's largest oil importers may drop significantly. In addition, aggressive steps taken by the Fed and other central banks may lead to a global recession and therefore to weaker fuel demand. All this made Brent crude slide to the level of $86 per barrel. At the close of the session, the quote rebounded slightly and finished the week at $87.50 per barrel. These are the trends of the last trading week, and now a new week and new portion of macroeconomic data are ahead. Don't miss our daily news reports and the weekly review, which is due tomorrow. Stay tuned and see you.